Hi everyone! In this lesson we are going to look at reversal patterns. First up, we are introducing double tops and bottoms.
Sounds good. These are reversal patterns, so if a trader spots one, it might mean a change in the direction of the trend is imminent. This should be an interesting lesson. So what are double tops and bottoms then?
The double top is a bearish pattern and the double bottom is a bullish reversal pattern. Within each pattern, a gradual change in market psychology is playing out. In a top, the bears are taking over from the bulls and vice versa in a bottom. Let's go through a double top.
So how did double tops form then?
First of all, it forms when there is a prior uptrend.
Okay, I'm with you so far. There needs to be a trend to reverse.
The price forms a high. This is typical of uptrends. Nothing here would suggest a reversal of the trend is imminent. The price then forms a low, and it's around this point it might break the upward preceding trend.
Oh, I see. I get that.
But the price then continues to form a second peak. However, it only makes it up to the level of the first high. There it hits a horizontal resistance zone. While the exact peaks are preferable, there is some leeway.
Okay, what next?
Double tops then form a decline from the second peak. The subsequent decline should show an accelerated descent, which is often marked with a gap or two, or maybe even a bearish Mirabuzu. Such a decline shows that the bears are really in control and a support test is imminent.
At the horizontal support line drawn from the first low?
Yes, exactly. Even after trading down to support, the double top reversal still isn't confirmed. This comes when support is broken.
Thanks for explaining. What about price targets?
We'll cover those in a moment. The broken support becomes potential resistance, and there is sometimes a test of this newfound resistance with a reaction rally. These tests offer traders a second chance to initiate a short. Next up, let's look at how double bottoms form.
Do they just form in the opposite way to double tops?
In most cases, yes. It's a bullish reversal pattern. It forms in a downtrend. Let's show you one forming. It has two similar lows, ideally on the same horizontal support zone. The all-important confirmation comes when the price breaks the upper resistance line formed at the high of the pattern. Okay, let's look at how to trade double tops and bottoms. Because they're just the inverse of each other, I'll describe in detail a double top and confirm at the end the differences in a double bottom.
What way would a trader look profit from identifying a double top?
With a double top, traders would be looking to go short, aiming to profit from the change in trend.
Yes, got it. And the price target?
Ah, yes. The projected price target is the distance from the high point to the support line. A word to the wise now. While the double top reversal formation may seem straightforward, good traders should take proper steps to avoid trading false patterns.
Okay, so what should traders be looking out for to ensure they don't trade a false pattern?
Well, first of all, make sure the two peaks are broadly similar in size and duration.
Okay, I'm following.
After the first decline, analyze the low for clues on the strength of demand. If the low drags on a bit and has trouble moving back up, demand could be drying up. In a bearish reversal, if it breaks the support trend line, then that's added to our evidence that the trend might reverse.
Got it.
Good. Perhaps the most important aspect of a double top reversal is to avoid jumping the gun. Wait for support to be broken in a convincing manner.
What about the risk management aspect? Where would a trader set their stop loss?
When the short trade was placed, a trader would set their stop above the support level. If the price returned here, then the pattern wouldn't be valid and the reason for going short would be gone.
That's a double top. What about trading a double bottom?
Let's flip our pattern on its head. All of what I've just described remains true. Traders are looking to initiate a long trade when the price is confirmed. The target is the height of the pattern from the breakout, and the stop loss would be below the old resistance line. Let's show you a bearish double top on a chart of euro dollar.
I can see the upward trend at the start, so where are the support and resistance lines drawn?
Let me add these here and here. We can see the first high here, followed by a low. This wouldn't indicate anything too out of the ordinary for a bullish trend. The next high is only the same as the previous one. We can see the sell-off from that high is fairly severe. A trader would be on the lookout for the support line break to confirm the pattern if this pattern were forming in a live market. There was a week or so of support before the price broke and confirmed the pattern. The price returned to test it here. This would have acted as an opportunity to short. Traders would add additional weight to a break of this support line because it's also at a round number for euro dollar, 1.37.
And the price target and stop loss?
Price target is the height of the pattern projected below the breakout. The trader would put their limit order at about 1.344. The stop loss would go just above the old support line. Okay, so we've looked at double tops and bottoms. Now let's look at triple tops and bottoms.
Sounds good. Are they similar?
Yes, they are. They're just extensions of the double tops and bottoms. The patterns last longer, both adding another high and low before the confirmation break. I'll try not to repeat what we went through with double tops, so let's assume the price action is here. The second high is in line with the first. The price retreats back to the support but returns to form a third high at the resistance level.
Yes, I see. It tested the support for a second time, but it didn't break.
A triple top is confirmed. The price then breaks through the support line. The descent from the third high is normally rapid. The bears have taken control. Broken support becomes potential resistance, and a test of the newfound resistance level usually confirms the break.
Great. Thanks for explaining these. They're very similar to double tops.
Okay, so I take it that triple bottoms are the inverse of triple tops. These patterns always seem to be at both bullish and bearish turning points.
Yes, they are, but this time it's a bullish reversal pattern. It forms at the bottom of a downtrend, has three lows, which ideally form on a horizontal support line and are confirmed when the price breaks above the upper resistance level. Okay, now let's look at how we trade triple tops and bottoms. The loss of support confirms the pattern and a trader would be looking to go short. When this occurs, traders measure the distance from the top of the high to the support and project it lower, below the support level, for a potential price target.
And is duration and volatility a factor?
Definitely, the longer the pattern develops and more volatile it is, the more significant the ultimate break. It's like this with all price patterns. When trading in a daily time frame, triple top reversals that are 6 or more months old represent major tops.
Okay, and it's the same for triple bottoms?
Yes, they get traded in a similar way. The price target is projected up from the resistance and the stop loss goes under it.
Got it. Thanks for running through these. Can we see one in a chart?
I want to show a pattern that isn't perfect but still a triple top. In trading, we don't always get perfection. Let's look at a chart in a daily time frame for gold.
Oh yeah, I think I see it.
As this pattern develops, technical traders will likely draw in the support trend line here. The resistance line isn't horizontal and this is now fairly close to a descending triangle. This is why confirmation is really important. If the price broke above the resistance line, it would be a confirmation as a continuation pattern. The price actually didn't break precisely on the third touch. It rallied slightly, which would have confused traders a little.
But crucially, it didn't break resistance. It broke the support line.
Yes, rather severely, and that is the confirmation that it's a triple top pattern.
If it broke it so quickly, how would a typical trader have traded this?
Well, first of all, the price target is worked out. This is the distance between the support and resistance lines at their highest point. A trader then projects this down from the support break. But with this pattern, it's unlikely a trader would have initiated a trade when it broke support. It did move down quickly. The best entry point is here. The price returns and tests the old support line, this time as resistance before moving down. The retesting and holding of the new resistance line helps add further significance to the pattern.
And the stop loss might be set above the old support line?
Yes, it seems logical to set it here, because if this resistance line gets broken, it's no longer a strong pattern. Next up, we are going to look at head and shoulders patterns.
That's a strange term.
It's actually a pretty good explanation of how to identify the pattern.
So what is a head and shoulders pattern then?
A head and shoulders is a long-term bearish reversal pattern. That means it forms in an uptrend and its completion marks a trend reversal. The pattern contains 3 successive peaks, with the middle peak, the head, being the highest and the 2 outside peaks, the shoulders, being lower and roughly equal.
The name makes sense now.
The lows of each peak can be connected to form support or a neckline.
Okay, so how do these patterns form then?
Firstly, it's important to establish what?
The trend. It's a bearish reversal pattern, so the price needs to be trending up before it forms.
Okay, just testing you. I'm always amazed when traders spot so-called patterns in sideways markets. Anyway, the left shoulder forms a peak that marks the high point of the current trend. After making this peak, a decline follows to complete the formation of the shoulder. The low of the decline usually remains above the trend line, keeping the uptrend intact.
Right, I'm following so far.
The pattern then starts to form the head. From the low of the left shoulder, an advance begins that exceeds the previous high and makes the top of the head.
Looks like a normal uptrend to me along a support trend line.
It probably is so far. After peaking, the low of the subsequent decline marks the second point of the neckline. The low of the decline usually breaks the trend line, putting the uptrend in jeopardy.
Okay, so that's the head and one shoulder.
We then see the formation of the right shoulder. The advance from the low of the head forms the right shoulder. This peak is lower than the head and usually in line with the high of the left shoulder. While symmetry is preferred, sometimes the shoulders can be out of whack. The decline from the peak of the right shoulder should break the neckline.
Okay, remind me about the neckline again?
The neckline forms by connecting low points between the head and the 2 shoulders. Depending on the relationship between the 2 low points, the neckline can slope up, slope down, or be horizontal. The slope of the neckline will affect the pattern's degree of bearishness. A downward slope is more bearish than an upward slope.
Okay, thanks for explaining.
The head and shoulders pattern is not complete and the uptrend is not reversed until the neckline support is broken.
Is that the confirmation?
Absolutely, that's when the price breaks the support of the neckline. When support is broken, it's common for this same support level to turn into resistance. Sometimes the price will return to the support break and offer a second chance to sell.
Okay, so we know how head and shoulders patterns form, but how would a trader trade them?
Good question. So after breaking the neckline support, the projected price target is found by measuring the distance from the top of the head to the neckline. This distance is then projected below the neckline to reach a price target.
That makes sense. It's similar for most patterns. What would add significance?
Well, the normal things like duration and volatility improve significance. With this pattern, while it's preferable that the left and right shoulders are symmetrical, it is not an absolute requirement. They can be different widths as well as different heights.
Noted.
With this pattern, if it's in a company share, a trader can normally track the volume traded. It adds significance if volume increases on the decline of the right shoulder just before the break, identifying the neckline support and volume confirmation on the break can be the most critical factors. The support break indicates a new willingness to sell at lower prices.
Right, so that provides traders with an opportunity to make a trade.
It does, but the combination can be lethal and sometimes there is no second chance return to the support break. Measuring the expected length of the decline after the breakout can be helpful, but don't count on it for your ultimate target.
So again, we should be looking to other indicators to confirm.
Exactly. As the pattern unfolds over time, other aspects of the technical picture are likely to take precedence.
Great, thanks for explaining this.
This is a 4-hour chart of the New Zealand dollar against the US dollar. I've already marked up a head and shoulders pattern. We can see both shoulders are smaller than the head. The neckline is not horizontal, it slopes down, which makes it a slightly more bearish pattern. The price target is set using the height of the pattern and projected downward. It would have been reasonable for a trader to set up a stop loss above the neckline. We can see traders trading this pattern in this way would likely have had a profitable trade. As you no doubt understand by now, most patterns in technical analysis can have the inverse. Head and shoulders is no different. Although a little less common, the inverse head and shoulders is a bullish reversal pattern that looks like this. Although we won't go through every step here, it's just the opposite of the head and shoulders. You should at the very least be aware of it.
Thanks, that's noted. It's a very distinctive pattern.
Let's move on to rounding bottoms. Okay, let's look at rounding tops and bottoms. These are long-term reversal patterns. They are also referred to as saucer bottoms or tops. They represent a long consolidation period that turns from either a bearish bias to a bullish bias or vice versa.
Thanks for the introduction. That means it reverses from a downtrend to an uptrend on a rounding bottom and from an uptrend to a downtrend on a rounding top.
Yes, sorry, I got a bit technical there. Let's look at rounding bottoms first.
So, how do rounding bottoms patterns form then?
So, like all of the patterns we've looked at in this lesson, in order to be a reversal pattern, there must be a prior trend to reverse. Ideally, the low of a rounding bottom will mark a new low.
Okay, that makes sense. It wouldn't be any use if it develops in a sideways trending market.
The first portion of the rounding bottom is the decline that leads to the low of the pattern. This decline can take on different forms. Some are quite jagged with a number of highs and lows, while others trade lower in a smooth fashion.
I think I understand.
The low of the rounding bottom can resemble a V bottom. but should not be too sharp and should take a few periods to form.
I'm with you.
The advance from the lows forms the right half of the pattern and should take about the same amount of time as the prior decline. If the advance is too sharp, then the validity of a rounding bottom may be in question.
Okay, so the advance from the lows needs to be steady in order for it to be valid.
Yes, that's right. The confirmation comes with a resistance breakout. While symmetry is preferable, on the rounding bottom, the left and right side do not have to be equal in time or slope. The important thing is to capture the essence of the pattern. So, rounding tops patterns form in the opposite way that rounding bottoms do. It's a bearish reversal pattern.
So in an uptrend, the price rounds and can form a little V at the top. It's useful if it's symmetrical, and the confirmation is when it breaks support.
That's it. Well done. Let's look at how to trade a rounding bottom pattern. As you'd have guessed by now, the rounding top is broadly the inverse.
Okay, sounds good.
So, bullish confirmation comes when the pattern breaks above the high that marked the beginning of the decline at the start of the pattern. As with most resistant breakouts, this level can become support.
That makes sense.
Traders set price targets by measuring the height from the lowest point of the pattern to the resistance level. Like most targets, this is projected up from the breakout.
Got it. Thanks for the heads up. What about the stop loss?
Like most bullish reversal patterns, this can be set under the old resistance line.
Thanks, yes, that makes sense.
Let's show you a weekly chart of gold. We can see a downward trend into a rounding bottom here. It's clearly not a V shape. Instead, the price rounds in a U shape. This tells us that there is a gradual and long-term change of power going on from bears to bulls. The pattern's resistance line is here at the top. Now, let's zoom in and take a look at the pattern in a daily time frame. The bottoming support line can be drawn here.
And if traders are looking at this pattern, would the confirmation be when the price breaks above the resistance line?
Yes, once confirmed, the next thing traders do is work out the price target. For this pattern, it's the distance from the support to the resistance line, projected from the breakout. This is quite a deep pattern, so we need to jump back to weekly to see the price target.
That's a big move.
Well, it's a long-term pattern, so the price target might be quite big. Traders can set their stop loss below the resistance. If the price retreats back to this level, the trend has likely not reversed and a trader would want out of the trade. We are going to introduce the last set of reversal patterns we are going to cover. Wedges can be rising or falling. Both types can also be either continuation or reversal patterns, depending on the preceding trend.
So quite a range then. I presume the confirmation is the important part.
That's right. To begin with, let's look at rising wedges. These are considered bearish patterns.
Okay, so how do rising wedges form then?
In order to be valid as a wedge pattern, there needs to be a prior up or down trend, the most common being the latter.
So that's when it's a continuation pattern, right? After confirmation, the price is continuing down.
Yes, it takes at least 2 highs to form the upper resistance line, ideally 3. Each new high should be higher than the previous high.
I get that.
At least 2 lows are required to form the lower support line. Each low should be higher than the previous low.
Okay, so it looks like a door wedge and it's sloping up.
Yes, it's a rising wedge. the price is contracting. The upper resistance line and the lower support line converge as the pattern matures. Every time the bulls push back and move the price up, it becomes less and less convincing.
In what way does it make it less convincing?
Well, the upper resistance line fails to keep pace with the slope of the lower support line and indicates a supply overhang as prices increase. This places a time limit on the pattern, which traders like.
Ah, okay. What next?
Finally comes the all-important confirmation. This comes when the price breaks the support line. The price might return to retest the old support line, now resistance. Falling wedges are bullish patterns. Like rising wedges, the preceding trend can either be bullish or bearish. A falling wedge forms an upper resistance line. It takes at least 2 highs to form the upper resistance, but ideally 3. Each high should be lower than the previous highs.
Okay.
At least 2 lows are required to form the lower support line, and each low should be lower than the previous lows.
I'm with you so far.
The falling wedge is developing in a contraction. The upper resistance line and lower support line converge to form a cone as the pattern matures. These new lows still fall past the previous lows, but it's becoming shallower. These new lows indicate a decrease in selling pressure and create a lower support line with less negative slope than the upper resistance line.
That makes sense. It makes a falling wedge shape.
Finally, the falling wedge is confirmed when there is a resistance break. A bullish confirmation doesn't come until the resistance line is broken convincingly. It's sometimes beneficial for traders to wait for a break above the previous high for further confirmation. As with rising wedge, once the resistance is broken, the price can sometimes return to retest the newfound support level.
Thanks for explaining those patterns. How would a trader trade them?
Okay, let's look at how a trader would trade a rising wedge on a chart. Here is one I've already identified on $yen. Both support and resistance lines slope up and the price is coming together. Wedges can be one of the most difficult chart patterns to accurately recognize and trade.
What makes it difficult to recognize?
While it's a consolidation formation, the loss of upside momentum on each successive high might suggest the bulls are losing steam. However, the series of higher highs and higher lows means not all trend indicators point to a downside trade.
Okay, I think I'm following. The other indicators, like looking at all 3 moving averages, are not all pointing to going short.
Correct. The final break of support indicates that the bears are finally on top and lower prices are likely.
Okay, so we'd be looking for a break in support then?
That's right. Unlike all the other patterns we've seen, there are no measuring techniques to estimate the decline, so other aspects of technical analysis should be employed to forecast price targets.
I presume all the other factors like duration and volatility play a part in determining its significance.
They sure do. This pattern is not particularly long in duration or height.
Okay, so although this is a rising wedge, it could be more significant.
Trading is a probabilities game. There are seldom times where everything is perfect. Let's find a falling wedge. Let's have a look at a falling wedge. This is the Euro-Aussie dollar pair back in 2014. This falling wedge is a really long-term pattern. It forms in an uptrend. It's coiling in with support and resistance being tested several times each. Finally, it fakes out below support only to return into the wedge. This is enough for the bulls and it rapidly pushes above resistance, confirming the pattern and carries on in an upward trend.
double top is a bearish reversal pattern. It's confirmed when a price action breaks below the support formed at the two lows. Traders trade the pattern by taking the distance between resistance and support and projecting below the breakout. They typically set stops above the support zone. The double bottom reversal is the inverse bullish pattern.
The triple top reversal is a bearish reversal pattern. There are 3 equal highs followed by a break below support. It forms in the same way a double top does, but with an additional high and low. Traders take set profit targets and stop losses in the same way as double tops. In the case of a triple bottom, the formation is again the inverse.
The head and shoulders pattern is long-term, bearish, and is one of the most common reversal formations. It's important to remember that it occurs after an uptrend and usually marks a major trend reversal when complete. The pattern contains 3 successive peaks, with the middle peak, the head, being the highest, and the 2 outside peaks, the shoulders, being lower and roughly equal. The pattern is confirmed when the price breaks through the support neckline. A price target can be set by taking the height of the pattern at the head and projecting it down. The stop loss can be set slightly above the neckline. The inverse head and shoulders forms in a downtrend and is also a reversal.
A rounding bottom is a long-term bullish pattern. It represents a drawn-out shift of power from bears to bulls. Confirmation comes when the pattern breaks above the resistance line formed at the beginning of the decline at the start of the pattern. Again, traders take the height of the pattern and project that from the breakout to get a price target. Stop losses are typically set slightly below the resistance. A rounding top is the inverse pattern.
Finally, we looked at wedges. A rising wedge can form in either an up or downtrend and is a bearish pattern. That means the price is likely to fall after, regardless of preceding trend. It's only confirmed when the price crosses through support. A falling wedge is a bullish pattern with the opposite characteristics.
Well done, everyone. The only thing I'd add is price targets and stop loss levels should be additionally supported by other technical analysis techniques. That was a long lesson with a lot of information to take in. You did really well. See you all in the module summary where we'll pull together what we've learned here.